welcome back to Learning Object 5 of Chapter 3. So since we already talked about all the scenarios of adjusting entry, accrued revenue, accrued expenses, prepaid expenses, deferred revenue, these 4 scenarios, right? We said we will updating the general ledger, right? Ledger of each account, right? So, and then because the updated balance of each account, we will transfer them to adjusted trial balances, right? The sheet has all the debit side and the credit side, right? We wanted to, and then at the end we want equals to each other. That means you balance your book. So right now, based on the adjusted trial balance sheet, trial balances, we wanted to talk about how do we communicate with outsiders. So to communicate with outsiders, we needed to use a financial statement, right? Hence that based on the trial balance sheet, we wanted to generating financial statements. Okay, so this is what happened during the soccer academy of the 2021. Here has all the accounts, the general ledger accounts with updated balances. Okay, debit side, credit side, debit side, credit side. As you can see, they did a great job. The debit side equals the credit side. So good, they balanced the book. The point now is that what account here is belonging to what kind of statements. Okay, so first of all, starting from this line, as you can see, right, it's what? It's belonging to income statement, right? Service revenue, rent expense, 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 expense. So this is income statement. Okay, stockholder equity should only contains what? Stockholder equity, during class we talk about it's composed by common stock plus return earning, right? And the return earning is usually equals to net income minus dividend, right? So here is statement of stockholder equity. We have always listing 3 accounts: common stock account, return earning account, and dividend distribution account. And then look at it here. They distributed $200 to the shareholder, and the return earning is equals 0 when it is the first year of the operation, right? Because nothing have happened yet. Okay. Okay. And then the next thing is that look at here, the green, in the things written in the green is balance sheet, right? We have all the asset account, we have all the payable, which is liability account. So now let's fill in this. It's a little bit messy. Let me trying to use eraser to erase some of the places that I don't need. Okay, so okay, so what we should do to fill in this? Let's give it an overview, right? So let's see what we can. Oh, doesn't change back. Okay. So balance sheet. Balance sheet, the golden standard is asset equals liability plus stockholder equity, right? Income statement equals the revenue minus expenses equals net income. Okay? Okay. And then net income is going to be portion of return earning. Return earning is going to be portion of stockholder equity statement. Hence, return earning, it wants us to write it. It should be net income plus minus expenses, minus dividend, right? Right? Net income plus beginning return earning minus dividend. Okay. Okay. So as always, remember the homework 10 for the question 10 for homework 1, starting from income statement as requirement 1 of that question. It's not by accident. It's because that's how you should do it. The closing, the communication process, preparing the financial statement from trial balance always start with income statement. Okay? Because the income statement, we can get a number, net income. And then once we finish net income, we will go to the stockholder equity statement, right? Because we can figure out return earning, and we can figure out the cash flow, common stock. After that, we get the equity total, right? And then we go to balance sheet, right? Balance sheet, we can see the asset side equals liability plus equity. Okay, this is the first thing you prepare, second thing you prepare, third thing you prepare. Okay, so for example, income statement for the period of December 31st is we have a revenue of 7,200, we have expenses for all this, and then we have a net income for 1,200. Okay. Okay, so this is a good, cool. So statement of equity is that, remember, we always talk about the beginning balance and change of the equity. We talk a lot about that during our exercise in the chapter 1, and we got the ending balance, right? Ending balance. Hence, the common stock in the beginning of December 1st is 0, right? Always return earning at the beginning of the business is always 0 because you don't have anything to return. Return earning always meant that something you made and you distributed and whatever left, right? So this is always going to equal 0 when it's the first period of the company. And then you issuance a new stock with the changing of stock of 25,000, right? And also during the period you made money from the prior period for 1,200, which is remember last slide for 1,200, right? So hence that add the net income for 1,200, and then you distributing dividend for 200. Hence, in the common stocks account, there's gonna be 25,000, right? Because you issued new stocks, and then return earning, you made 1,200, you distributed 200, you left with 1,000. And then so the total stock equity, you have to cross footing, meaning the row has to be added up in the end. Each row has to add up in the end, and each column has to be added up. So 25,000 plus 1,200 is 26,200, and minus 200 is 26,000, right? And then cross footing, let's add in 25,000 plus 1,000. Yes, it's 26,000. Hence, it's correct. Okay. Okay. Once you prepared the stockholder equity statement, then we can prepare a balance sheet. The balance sheet, because this amount here, did you see this? Common stock and return earning and total stock equity, it has to be exactly same coming from this sheet, right? So 25,000 and 1,000. You figure this part out, right? Now you just need to fill in the asset. We separate the current asset versus long-term asset. Current asset is asset benefit shorter period of time, and long-term assets is beneficiary to the company more than one period, more than one operating period, right? And remember, we said accumulated depreciation is a counter equipment account, meaning always reduce the balances of the equipment, right? So this way we know what is the cost that we purchased this equipment and what has been depreciated, okay? And then liability will also separate from current liability and total liability, long-term liability. And we want to have a number in the total liability as well, okay? So as you can see, the total liability, the current liability plus the long-term liability is gonna be this is 20,000, hence that is gonna be 23,600 for the long term, right? For the long term. So then 16,400 plus 23,600 is the 40,000. And the total liability, current liability is 4,000, and total liability is 4,000 plus 10,000 is 14,000, plus the total equity account is 26,000 is 40,000, right? So this plus this is 40,000, and this plus this number is this number, and this equals this. So this is balanced. Okay, statement of cash flow is something we will talk about in chapter 11. Okay, this statement, as we kind of briefly mentioned in chapter 1, we wanted to understanding how the activity involving cash receipts and cash payments, and we want to reflecting a company's operating cash flow activity, investing cash flow activity, and financing activity. Okay, so this is just a big concept, but we will talk about exactly how to record, how to presenting the cash flow statement. Okay, so which financial statement would include a net income? Oh, income statement, right? And statement of stockman equity, yes, because this stockman equity will remember stockman equity is beginning balance plus equity, right? This statement is always gonna have a beginning equity, right? And then we will plus net income, right? Minus the dividend, and equals the ending equity. Okay, so net income is in the statement of equity, right? And we know this one is called a return earning for this period, hence this one. Okay, yeah, net income is the final result in the net income statement. This amount is also transferred from the income statement to the statement of stockholder equity. So the line item for the net income would be appear both in statement of equity and the income statement. Okay. Okay, great. So closing process. Why we need a closing process? Is because that we finished one accounting cycle, and we're gonna start the next one. And there's a certain account need to be cleared to zero. And this account called a temporary account. And what kind of account is temporary account? That's what we need to figure it out. Okay. So we want to first of all demonstrate the purpose and recording the closing entry. Okay. Closing entries transfer the balance of all temporary account. The temporary account including forever remember revenue need to clear to zero, expenses need to clear to zero, and dividend need to clear to zero. Okay. Look, this income statements account, this is on the statement of equity account, right? So these three accounts need to be close to zero, to the balances of return earning account, because all these three is contributing to return earning, right? Net income minus dividend is return earning, right? So net income equals revenue minus expenses minus dividend. As these three accounts balances has to transfer to return earning account. And how do we do that? We're using closing entry to reduce balance of these temporary accounts to zero to prepare them for the next period. Okay, closing entries transfer balance of all temporary accounts. Okay, so this is the answer for the previous slides. Let's see, how do we do that? Three accounts, revenue, expenses, and dividend, we need to clear out. So first of all, before we go through, I wanted to ask you, revenue account, what kind of balance it should be? Expense account, what kind of balance it should be? And dividend account, right? So in the chapter 2, we talk about revenue is the credit account. It's always have a credit balance, right? You should always have a credit balance. And expense should always have a debit balance, right? Dividend should always have a debit balance. Hence, to close them, what do? We will take the credit side to the debit side for revenue. We will take the debit side of expense to the credit side, right? We will take the debit side to the credit side. In other words, that we will debit out all the revenues, okay? Right? And we put them into return earning account. Okay? Another mean, and then see, and for the all expenses, we will credit all expenses. See, we credit them out. Then this side we will debit them out. We will credit them out. See, this is for revenue, we debit them out. We debit all the things. And for the expenses to close it, we credit them out. This thing gets cleared to zero, right? And then we put all this into the bucket of return earning. And 3, for the dividend, what we credit them out for 200, right? And we dump them inside of the return earning. Okay, so more specifically, see, the return earning become the bucket that before closing is 0, and it's receiving 7,200 from the revenue side, and receiving the expenses from on his debit side, and receiving all the dividend on the debit side. Hence, the ending balance return earning should be a credit side, right? Return earning is a credit side account, right? Okay, so before we go further, I just wanted to using a bucket thing to tell you how to closing the entry, right? So we have 3 buckets. We have a revenue bucket, we have expenses bucket, and we have dividend bucket, right? So, and usually if this is T account, this is T account. This is if this is a bucket, right? We usually if the bucket and this side means debit, this is credit, debit, credit, debit, credit. We know revenue usually have a credit side balance, and expenses usually have a debit side balance, and dividend have a debit side balance. Now we need to dump all this. We need to clear them. We need to dump them into a big bucket called return earning bucket, and it also have debit side and credit side. This is returned earning. How we do that? We will credit out the revenue and we put it into the credit side. We will debit out our revenue. We will credit inside of the return earning. We will credit out our expenses. We will debit into the return earning account. Same thing, we will credit out our dividend, and then we will debit into our return earning. Hence, our return earning will become a bucket summarizes all the revenues and all the expenses and all the return earnings. Okay, so I will draw this again if you didn't watch video in the class. Okay, so common mistakes. Students sometimes believe that closing entries are meant to reduce the balance of return earning to 0. Absolutely not, right? So if you understand this concept, you will know that return earning is the bucket stays forever. Because it's on the balance sheet, it's not a temporary account, right? Hence that return earning should never reduce to 0. Return earning is a permanent account representing accumulation of all revenue, expenses, and dividend over the life of the company, right? Permanent account. Okay. So let's see. If we're posting all the closing entries and we wanted to prepare a closing trial balances, So the post-closing trial balance is a list of all accounts and their balance at the particular date after we have updated the accounts balances for the closing entry. So by the way, trial balance is before adjusting entry, we have a trial balance, right? And then after you have all those accrue and prepaid those transaction adjusted, you have adjusted trial balance. And then after your closing entry, you have post-closing trial balance. So there's a 3 set of trial balance, right? So the post-closing trial balance helps us to verify that we prepared and post-closing entries correctly, and that accounts are now ready for the next period. Okay. So as you can see, post-closing trial balances should always have what? Only have the balance sheet accounts available, right? You should not see revenue accounts or expense account. Okay, so all these are cash, accounts receivable, equipment, right? All these are the asset side, and all the accounts payable and utility payable, blah 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 blah. These are the liability side, and all these two are the equity side, right? And then they are in balance. So this is a posting trial balance sheets should only contain balance sheet accounts. They should close out all the income expenses accounts. Okay. Which of the following accounts would find on the post trial balance sheet? So if you do this, you will know that exactly. So you have to only pick the balance sheet accounts, right? Dividend, no. Return earning, yes. Rent expenses, no. Service revenue, no. This only exists in what? Stock equity statement. And this one exists in income statement and the stock equity statement, right? This is also income statement and stock equity statement. Okay. Okay. So I will make another summarization video just to give you a quick overview of chapter 3. But I know there's a lot to take, especially second video. But please try your best to listen to it. And also you can go through the slides on your own time. Hence that we're gonna talk about some important concept of the chapter 3 in the class and some exercise, and hopefully that will help you to understand it further.